The Nigerian economy has been classified as one of the most volatile economies in the world due to its large dependence on oil revenue. Economic instability is witnessed yearly through rising inflation, massive unemployment, low output, and dwindling foreign reserves that results to unstable exchange rates. Amid the second wave of the pandemic, the economic recovery is expected to be weak and gradual under current policies, as real GDP growth in 2021 is expected to turn positive at 1.5%. Although the country's economic potential is constrained by many structural issues, including inadequate infrastructure, tariff and non-tariff barriers to trade, obstacles to investments, lack of confidence in currency valuation, limited foreign exchange capacity, and worsening insecurity, which is posing a threat to the growth of foreign direct investments into the country. For some experts say policy adjustments and reforms by the fiscal and monetary authorities designed to shift the country from its dependence on oil to diversify the economy towards private sector-led growth will set Nigeria on a more sustainable path to recovery. Well, to discuss more on this and, of course, burning economic issues as it affects the Nigerian economy, I have joining me live from the United Kingdom via Skype as the chief economist at PricewaterhouseCoopers, Dr. Andrew Nevin. Dr. Nevin, good afternoon. Thank you for your time.
Tolo, it's a great pleasure to be with you today.
Yes, very quickly, I want to take you back to a worker that earns 35,000 naira minimum wage, 30,000, some are even paying 18,000. With the Nigerian economy at the moment being projected to grow at 1.5%, fuel prices on the high side, we might likely fully deregulate. What type of life do you see a Nigerian worker living in 2021?
Oh, Tolo, I mean, we all know the answer to this. It is a very difficult economic situation in Nigeria. We've had, as you say, very high inflation. I think 17-18% was the last number from the CBN, though it's, from the Nigerian Bureau of Statistics. It's sometimes hard to keep track. And we all know it's very difficult. We know there's food inflation, we know electricity, we know there's pressure on the oil price. Everything in the market that's imported is going up as well. So it's a very difficult time.
Now it's the difficult time. Before we go to all of that, we've seen moves by governments to try to cushion the effect of some of these challenges. Are we to say it's not a step in the right direction, or more really needs to be done? The central bank has been in the center of this, a little support from the fiscal side. What's your assessment of all of these interventions put together?
Well, I mean, any individual intervention, of course, has a justification, whether it's anchor borrower program or the creative industry intervention or shutting the borders to encourage local production. We've all heard the arguments why these are beneficial. But I mean, in totality, we know that headline economic growth is low. We know that unemployment is increasing. We know inflation is very high, and we know that poverty is increasing. So it's just difficult for me to understand why a policymaker would claim success in these circumstances. I mean, there's certainly been efforts there, but when you look at where we're at now compared to if we go back 6 years ago, where we thought we would be at, it's a very painful time for the country.
So through one way or the other, many Nigerians continue to slip into the poverty line. Because if we are projected to grow at about 1.5% or 2%, and our population is growing at about 4%, if not even more, what does that really depict to Africa's most populous nation?
Well, we know since 2015, and I don't want to choose 2015 because it was the beginning of this administration, but we can choose it because the oil price drop sort of caused some dislocation. But we know that Nigeria has had headline GDP growth below the population growth in 2015, 2016, 2017, 2018, 2019, 2020, and now 2021. So, I mean, I think that's 7 consecutive years of declining income per capita. And, automatically, if we have declining income per capita, we're going to have more people in poverty, and we're going to have more people unemployed and underemployed. Now, I mean, I applaud the government's efforts even Even last week, of course, we had the new committee struck for addressing the 100 million people in poverty, chaired by His Excellency, the Vice President. I mean, that's a positive step, but we just don't seem to be putting together a set of policies that results in better headline GDP growth. And there's no solution out of it. As I said, I think the CBN and the ministries and the Vice President certainly make huge efforts. But at a fundamental level, we're kind of, maybe using an old expression, kind of, to some extent, moving the deck chairs around the Titanic, right? We're not addressing the fundamental issue why, even though we're such an attractive market to, internally, externally, we're still growing at such a low rate. And of course, it's not like this is an Africa issue, because there are many pockets of Africa that are highly resilient, have been growing very fast. I did an event last week with His Excellency, the President of Ghana. I mean, Ghana in 2020, despite the pandemic, had positive growth rate. And despite all of the challenges that we all face, they've had growth rates above their population growth rates in 2019, 2018, 2017, 2016, as far back as I can remember. So it's not impossible for Nigeria to get that same kind of performance. We just are not getting it.
Things like this, we look at the fiscal side, consolidating whatever is being done by the monetary side, which is key at this time for a country like Nigeria. Do you see that playing out better than it used to be? Some say yes, well, it used to be very good. Now it seems better. Some say no, we are there already. So I don't know. What's your assessment of that relationship? That handshake needs to be a regular one. But sometimes we see policies, somersault and contradiction from the fiscal side and the monetary side. Business people are talking about this.
Yeah, I mean, there's some different dimensions in this. Obviously, the monetary side, the currency issue is a real headache for business and for everyone. And we have advocated the unification of exchange rates for the simple reason that as long as this confusion persists, there's a few things that happen. One of them is, business can't really operate. I mean, every business, even if you're producing within Nigeria, you have some inputs that come from abroad. So the result of creating such a complex currency regime is those inputs, it's very difficult to get them. So then you close down the whole assembly line because you can't get some inputs that are from abroad. So all the value added that is in Nigeria, all the employment that's in Nigeria, in a sense, disappears on that. The second reason we've kind of advocated for this, and we understand all the reasons to have this managed exchange rate, but at the end of the day, people will not, including Nigerians, are not going to invest in in an environment with such a complex exchange rate. So the net result is we don't get enough investment, and we don't grow fast enough. So that's one angle to it. But the second angle, it continues to be the ease of doing business. It is just simply too complex. I mean, and I say this not just as an economist or not just as someone who runs part of PwC in Nigeria for a decade, but also someone that's been involved in a number of startups in the Nigerian space, in fintech, in clean tech, and it is just very hard to do business. And business people have the sense that the moment they have success, they're going to be subject to multiple taxation, both the legal taxes, but also other sorts of forms of extraction. So in a sense, you can't grow up your business in an easy way. And until this environment changes, we're going to continue to have these problems on that. I mean, people refuse to invest in Nigeria. I think I've used the numbers here before on the program, and the economist term, gross capital formation. We only get about 16 to 19% of GDP reinvested in the economy every year. At that rate, you'll only grow 1 or 2%, which is what we see. But we need 6 to 8% growth, which means that we need investment in the rate 27 to 30% of GDP. So there's 10 percentage points of GDP. People are refusing to invest in this economy because it's just too hard. And the net result is we continue to get poorer and poorer per capita. And it's very disappointing, because on the other hand, there are also lots of positives that I see. And I will say to everyone, of course, I'm very optimistic in the medium term for Nigeria, but we are working through some issues, but some positives. There's a lot more sense that it's critical for states to lead development. Even listening before coming on the show, you were advertising your show about the Kano state development and made some critical points about Kano, and it's fantastic to see a state stepping up and taking its own responsibility. I mean, the second issue, of course, is the power of the diaspora. I mean, we wrote a paper 2 years ago now, and I think people widely understand that the diaspora is much more important to us than oil, and there's a lot more focus that we have NIDCOM and Chairwoman Biki Dabiri, who's doing a fantastic job there. They just put their strategy technology through the FEC the other day. So that resource is critical and really shows that what we're really exporting out of Nigeria is brains, and we should focus on that. A third issue I think that's really come on the table that we helped to put there was the unlocking of dead assets. We said, look, unless you unlock real estate, unless you unlock state-owned assets that are currently dead, we're not going to be successful. So now we see, including the Minister, Her Excellency, the Minister of Finance, for example, uses the term dead assets. Other people are doing it. They're trying to unlock it. States are trying to unlock it. The federal government is trying to unlock it. So I don't want to paint a picture of doom and gloom. As I said, I'm still heavily invested in Nigeria. It's my home, and I'm looking forward to coming back when I get my second vaccines. But I've seen a lot of progress. We just haven't quite had the structural breakthrough, though.
I want to take us back to the issue of unification of the exchange rate, which is very important with our discussions for us to be able to attract foreign investment into our country. Now, you've noticed moves by the CBN again trying to attract more forex into this market. The Naira for Dollar initiative, we can go on and on. Diaspora remittances, a lot of partnerships with the IMTOs to be able to attract these monies in. This has worked in some countries perfectly well and shored up external reserves. But it seems not to be working that way for us here. What could be the major challenge?
Well, to begin with, I think in a sense it is working. We do attract a tremendous amount of remittances. The diaspora is a very successful professional diaspora. If I had to contrast a bit with the Philippines, which also has a high level of remittances, the Philippines are fantastic people, but a lot of the workers are low-wage workers or work in the domestic industry in Hong Kong or domestic industry in the Middle East. So the number of people you need to get that large amount of remittances is very high. Whereas in the case of Nigeria, we have a lot of high wage earners, or salary earners. In the United States, the average Nigerian American earns more than the average American, which is just an extraordinary accomplishment for such a young diaspora. So again, though, if we go kind of to the structural issues, I absolutely applaud more strategic focus on the diaspora, which also means taking care of them. There are some issues now around what are the political rights of the diaspora, for example, that needs to be addressed. If we take a cue from India, they have the non-resident Indian passport to be able to, or resident cards to be able to pass easily in and out. Those are some things to think about. But in terms of the remittances, no member of the diaspora, or very few, I would think, would want to be sending money to their relatives or for some other purpose in their community at 380 or 410. When the market price right now is reflecting the parallel rate at 480. So it's obvious if you try to stick to that managed multiple exchange rate regime that the diaspora is just going to bypass the system. They're either going to choose not to remit the money, or they're going to choose to use some kind of unofficial channel at the 480 price, right? Or the Aboki system that we know well. So, and I appreciate the CBN's efforts with the 5 Naira bonus per dollar sent in. They obviously recognize how critical it is. But again, fundamentally, a little bit like the foil subsidy on the unification of the exchange rate and making it attractive to the diaspora, we're kind of going inch by inch by inch without taking any really hard structural decisions. The government came out in the ERGP years ago and said we wanted to move to a market-determined unified exchange rate. And there have been moves to that in the INE window, et cetera. And yet just when you could take that final step, there seems to be reluctance to do it. So it's a little bit like two other issues. On the foil subsidy, of course, a year ago, everyone came out and said the foil subsidy was gone. But as oil price crept back up, which obviously benefits the country, that foil subsidy got reintroduced through the NNPC. And now the NNPC is saying, look, we can't afford the oil subsidy, the foil subsidy. So, taking that final decision is hard. And people might have read that in the last month, if I read it correctly, there was only 13 billion naira transferred from NNPC to the Federation account. Well, 13 billion naira is 65 naira per person. And the NNPC GMD came out recently and said, look, one of the reasons we're not able to transfer a significant amount to the government right now is because of the foil subsidy. So it crept back in. And similarly on the electricity, I mean, the problem in the electricity market is all of the capital equipment for electricity is imported. We're paying a world price, whether we want solar panels, whether we want gas turbines, whether we want hydroelectric equipment. We're going to pay a world price. So that is going to be what sort of cost-reflective tariffs are going to be. And again, we have edged towards making that decision, and we announced that decision, and yet not quite able to implement it. So all of these places, we're really backing off making the hard decisions. Now, if you wanted to help the bottom of the pyramid, I mean, let's take a page out of the book from India. I mean, we would be much better off, rather than subsidizing foil, where we also subsidize our neighbors, to simply transfer 10,000 naira to every Nigerian adult. And of course, that goes to another, thing that we see in Nigeria was often we have these coercive policies. So if you take the NIN, for example, if you take the equivalent in India with the Aadhaar identification program, the reason people enrolled in Aadhaar was they got a benefit from enrolling in Aadhaar. Imagine we had the NIN where you said if you enrolled in the NIN, you got 5,000 or 10,000 naira a month. The oil money in effect came to the people. I mean, that would be a much more efficient way to transfer money to the people if we wanted to help the bottom of the pyramid than keeping the inefficient foil subsidy. So in each of these cases, the decisions are made to not quite push through the final resolution. And of course, we have the case of Egypt over the last 5 years, who had a similar exchange rate regime, and about 4 years ago just took the decision and said, look, we can no longer live with this. We're going to liberalize the exchange regime. And they had a one-time devaluation, but since then, this currency has been stable or appreciated, if I understand correctly. And of course, they've had massive inflows, both from like the diaspora, the Egyptian diaspora continues to float them, but also in the capital account.
All right, almost finally, Andrew, we had a budget, beautiful document that we all commended, timely and all of that. But now what is staring us in the eye is revenue challenge. How do we meet up our revenue, our obligations with regards to revenue? Now, lately, just like you said last week, the NNPC, though they said that's not affecting their financial standing, but they're already coming out to say, yeah, we might not be able to support FAC as we used to do. So how do we shore up revenue at this time? We're not exporting anything aside from crude oil.
Well, of course, you know that my response to that would be we actually export Nigerian brains. That's our biggest export through the diaspora. And now increasingly services are being delivered from Nigeria, which are exports. So Amal Hassan's company, Outsource Global is an example. We export Nollywood, we export music, so the creative industries. And you even see Nigerian financial services, which are essentially exports of brains, but exporting financial services increasingly playing an active role in Africa. So that includes the fintechs like Paystack, Flutterwave, and InterSwitch, also includes the number of the commercial banks with Axis and UBA, for example. So we are exporting things that are higher value added than crude oil, and in fact, there is no future in exporting crude oil for long-term future, or even medium 10-year future for us. And we really should be de-emphasizing it and emphasizing exporting brains, exporting high value added services. But in terms of the revenue, again, I come back to there is no way out of the revenue pressure if we continue to have low GDP growth. Because if you think about what's happening, we're getting poorer and poorer per capita. Simultaneously, the fiscal authorities are putting more pressure on people to pay taxes and multiple taxes. And that's very difficult to take more out of the system when people are getting poorer. And of course, then you go back to your kind of basic political theory that you learned when you were in university. We have a social contract, and the social contract in the past was the government didn't ask for any revenue because it got what it needed from oil, and very small amount. It only spends, that's 8% of GDP, which is tiny compared to other countries, but it doesn't give you anything. So it doesn't give power, it doesn't give healthcare, it doesn't give education, it doesn't give security, certainly, which is perhaps the major challenge at the moment. Or infrastructure. So now the government, if they're raising more revenue, in effect are changing the social contract. They're saying, no, you actually, as a public, all levels of public need to now pay into the government. And of course, the people are going to say, rightly so, well, wait a minute. Before, I wasn't getting anything and I wasn't really paying. Now you're asking me to pay. What am I getting for it? So, in a sense, unless the government, in my view, shows it's able to deliver some of the services, we're going to be increasingly fraught with these increased fiscal demands. And I perfectly understand it because, of course, the fiscal situation as it stands is not sustainable. But again, I come back to say the only way out for the country is headline GDP growth. And I say that as someone who stood up on your show in many forums, and I am not a big fan of GDP. It's a very poor metric for what's going on in the country, but it does measure just the quantum of money flowing through the economy. And right now, we need a bigger headline GDP economy. And all of the other things that we discuss can't work if we continue to have headline GDP growing slower than the population growth, because it simply means people are poorer and poorer, and you cannot extract more out of the system when people are poorer and poorer.
Andrew, before I let you go, if we can do this in 1 minute, we'll have an MPC meeting soon, and these guys will sit in that room. They have a lot on the plate to grapple with. What do you think will be the focus of that committee at their next meeting? Any projections, any shift in any of the parameters?
Well, I don't make projections, as you know, especially about the future, partially because we're also all affected. I mean, we're not just here, certainly I'm not here as an observer of the economy. I want to make a positive impact. I think that from a technical viewpoint, the CBN's MPC committee is fantastic. I mean, it really understands its role. So if you take like the headline interest rate, you take the CRR, for example, loan to deposit ratio, they're also interested. All of those things, I think they manage very well. The problem is the rest of the system isn't getting the headline GDP growth. Again, they're kind of rearranging a little bit the deck chair. So I feel for them. But the CBN is perhaps our most high quality kind of on a world scale technical group. I remember the CBN governor won Governor of the Year in 2011, for example. They continue to have a very strong economics department, very strong supervision, as we've seen recently on that. So, I think our challenges really have. I don't think the CBN can fix it, right? So if you take the analogy, the CBN is like a race car driver. So the rest of the structures build the race car. So, but if you put CBN into a race car from the 1920s, it's only going to go as fast as the 1920s. If you put it into 1950s, it's only going to go as fast as the 1950s. So it's up to the other institutions in the country to build a better race car for the CBN to drive.
I must thank you so very much, Chief Economist, PricewaterhouseCoopers, Dr. Andrew Nevin. Thank you for spending your time with us. We appreciate it.
No, thank you so much, Tolo. It's always a pleasure to discuss these critical issues.